This week we're talking about financial crises, and I picked a few significant cases in our recent history to provide you examples of, um, not just commercial banking crises, but financial system crises. And I think our focus is more on the um, failure of the regulator, failure of um, the supervisor of the financial systems. And for Wednesday's class, I did discussions about Bernie Madoff. I have the very famous 60-minute episode for Bernie Madoff, and it's really interesting. I actually provided the YouTube link for you on Canvas, and then I have a bunch of small, short articles for you to look at the details, and it's really an interesting case. So I want to talk about what is a Ponzi scheme and what Bernie Madoff did and how he actually failed ultimately, and he hurt a lot of people. Quite a few people committed suicide, and um, he himself died in prison, and his sons passed away. You know, sadly, and so it is a significant failure uh, of our financial system. So let's go ahead and talk about what is a Ponzi scheme and how does it work and how do we protect ourselves from a um, Ponzi scheme. So, the idea always starts actually, in my opinion, nobody starts the Ponzi scheme by saying, I'm going to actually start a Ponzi scheme. I think everybody starts good, and at one point they realize that they may have to stray, or sometimes it just becomes, point of no return, and that you're basically stuck with it. So let's start with, say, month number one, right? So let's say that you have a client with $1,000, and and then another client with another $1,000, another client with another $1,000, and so on. So let's just say that we actually have significant number of $1,000 clients, right? One client, number two, and as we increase the number of, oops, so as we increase the number of clients, obviously we get bigger. And at one point in time, I think the Bernie Madoff uh, fund was about $65 billion. And it lasted little over 17 years. And in that time, uh, I think towards the end, we had a few whistleblowers, but in that 17 years, nobody really actually noticed what he was doing, or that nobody either didn't care, or it's hard to explain how a Ponzi scheme of that magnitude could actually last 17 years. And at the end, you only have a handful of people to blame. Or is it? Or do we? I mean, like, I think there are a lot more people that we need to blame. But anyhow, let's talk about that Ponzi scheme. So the first month, let's say that we had a 1% return that we declared. I mean, it's substantial for a 1 month return, but let's say that that's what we did. So all really I'm doing is I'm basically writing down the 1% that I have to have a payout for all of these clients. Um, so obviously for me to be able to pay out a 1% return, I have to actually earn that 1% return. And if I cannot earn that 1% return, where will the money come from? Right? So it's $140. I have 14 clients. And if I actually make the money, it's great. But if I didn't make the money, then I shouldn't be actually saying that I am going to pay you a 1% payout. But from a hedge fund perspective, I think what made the Madoff so long lasting is that he actually paid these incredible returns month after month, year after year, that people just could not believe how good he was or how good he was. And, perhaps even though it was too good to be true, people just thought that he was just that good. So, for a hedge fund to be able to have a payout of that magnitude, it's supposed to actually have earnings to pay that out. So let's say that the first month I have that actual payout, I actually earned that money and I paid the first $140. So let's go to the second month, and the I will have the same amount, and then I will have another return that is 1%. But notice that this time I might actually have, because I'm doing so good, I might actually have more clients. And so much so that because, I'm see how good I am, I'm paying 1% a month. I mean, that's a fantastic return for whatever standards. I mean, so now I have 28 clients, and now I need to pay them the same 1% that I actually paid or I declared that I'm going to pay. So now the amount of money that I have to pay is increasing. And again, if I actually earn the money, not a problem. Great, I made so much money and I am paying it out. I'm basically sharing the success of my portfolio, and therefore everybody goes home happy. However, if I don't have the money, if I didn't actually earn it, and I'm only trying to, um, just save face, and I don't want to lose clients. I just want to be able to keep paying out the same payout as if I had made the money. And like I said, I don't think that anybody actually starts out by saying I'm going to become a Ponzi scheme. But I think the idea is that there comes a time that if you actually keep paying everybody a very significant return month after another month, and then there comes a time that you just don't earn that money and you still want to pay that, then what you can do is, well, the last client that you have right here, you could actually use that $1,000 to pay off all these individual monthly payouts. And that's what makes it a Ponzi scheme. So, which means that you every month, if you do not have enough earnings or enough return that you have earned yourself, but you promised a payout, all you're going to do now is that you will include new clients into the scheme, and some of these new clients will actually end up paying the payout for the others. So if I actually have a $270 of a payout right here, and I'm going to use this client um, 28 as my um, cash cow. I'm going to use that cash to pay this 270. So now remember, what happens is I need to actually have $28,000 in the account. But remember, I actually paid $270 into the payout pool, which means that I'm actually short about $270. So my account now has this much money. Oh, sorry. And unfortunately, the next month I still have to pay, but I also have to pay this client as well. So what I need to do now is I need to include or increase the number of clients every month, and so much so that I simply have to, there will come a time that I will simply have to pay the payouts only if I have clients. So, what Madoff did was, in that sense, um, quite intricate actually, because it's a fragile system. If you cannot find the next client, then you cannot pay the payout. And the problem is, if you cannot have as much or as high of a payout, then some of your clients will walk away. But remember, you don't have everybody's money now. Like, think about it. Because I actually paid a payout from the 28th client's money, if all of my clients wants to walk away, then I don't have $28,000 to pay. So that's where the system fails. So that's why the Ponzi schemes are notoriously fragile, and they require a constant growth and new clients in every month. And I think one of the um, you know one of the strategies that Madoff had was to create an exclusive club feeling, in that you could only become a client if you were invited. And therefore, when people, had this exclusivity or the feeling of exclusivity, they usually didn't want it to leave, because once you leave, you can't get back in. And therefore, he maintained that longevity of individual clients within the portfolio. So that was actually, I think that's what made this Ponzi scheme so long lasting. But like I said, the main issue with a Ponzi scheme is, well, you have two main problems. One, you have to have a new client every before every payout, because you need that client to, or you need that money coming in from the new client to be able to pay your payout. Number two, you need to have your clients stay. You cannot afford your clients to withdraw their money. You simply don't have it. And perhaps the third one is that if you have any portfolio for real, you should not have any losses. So, but then again, after you reach to a certain level of portfolio size, you may not actually have a portfolio of investments. You may be simply just running a Ponzi scheme in and of itself without actual investments. Although I think that at the SEC investigation, they said that they froze assets in the excess of $170 billion. I'm not sure how realistic that is with respect to the valuation of assets, but uh, as far as I read, the Bernie Madoff Ponzi scheme was about $65 billion, and it actually lasted a little over 17 years. So, we are looking at one of the biggest problems in our recent history with respect to the failure of the regulator, of the supervisor. So there are quite a few TV series, the movie, and obviously documentaries about Bernie Madoff. It really hurt a lot of people, and that it was because it was such a long time and such a big portfolio, and I think the biggest Ponzi scheme ever. It actually attracted significant attention. So the SEC actually sued Bernie Madoff for a fraud of $50 billion, and violation of Securities Act of 1933. So Ponzi schemes are illegal. And however, there is an investigation of the failure of the SEC. So to me, this is one of the interesting parts, and this is why I wanted to bring this as our course content. We talked about how the Fed, or the central banks, and the SEC in that sense, and the other regulators, even internationally, are obligated to um, do their audit. And in the case of banking, we are even talking about instantaneous um, statistical and audits. So Fed can actually have access to daily data from commercial banks, um, because commercial banks can actually inflict contagious financial pain on the financial markets. Um, so when it comes to the SEC, their job is to make sure there's transparency, and that that transparency is available to everybody. So I'm not 100% certain as to whether the accuracy of the data is in the purview of the SEC, or at least was it, and in the purview of SEC. Meaning, yeah, obviously the companies have to file, um, the true financial situation. If they get caught, obviously they get into trouble. That's fraud. However, what I mean is, when it comes to commercial banks, you actually have Fed preemptively audit banks all the time. We have an active, um, you know, a you know, sometimes Fed can even be present at banks, or Fed auditors can be present at banks to do an actual internal audit, not just an audit from afar where the bank provides data and the Fed says thank you, but more like an actual auditor going to the bank, inspecting it on site. So I'm not really sure if SEC has um, that preemptive authority to inspect institutions, and or if they had it in the case of Meta. However, um, I think the failure now is a little bit more with respect to, this has been going on for 17 years, and the returns that were paid were such high rates that I think they were suspicious enough for a case for SEC investigation. So, I don't think that we can expect our regulators to be on site like the Fed for the commercial banks all the time, considering we have little and large banks and probably tens of thousands of mutual funds, the hedge funds, the ETFs, and there's always retrospective legal issues if these fund managements or portfolio managements do fail with their honesty. However, preemptively, I think that the authority that Fed has over commercial banks is not extended to any other supervisor in the financial markets. So, in the case of let's blame the SEC, I think the case is more about not that they couldn't catch it, but how could they actually not catch it after 17 years? That they had to have a whistleblower come forward. And then, and only then, the market becomes aware. And then only then SEC becomes. So I think that, I'm not even sure if it's realistic to expect even the, funds that keep paying these astronomical returns to become suspicious. I'm not sure if SEC is the regulator to become suspicious of extraordinary returns, or however, like I said, there's obviously a failure of regulation, and I'm not sure who to blame. But I think one thing that I want to emphasize here is that when it comes to the commercial banking, we have the FDIC, which actually protects the rights of the deposit holders. And this is important because we always believe that the deposit holders are vulnerable and that they need protection, and FDIC provides that protection, and they basically become preemptive. FDIC becomes, preemptive protector of deposit holders, for, at and within commercial banks. Through continuous supervision, continuous audit, and continuous enforcement, FDIC becomes quite active. Now, from an investor point of view, we do not have that protection. The SEC is more of a, transparency, and then, after the fact, enforcer of financial regulation. So I think that when it comes to financial investments, the investors and traders are at a different risk domain than the deposit holders. Deposit holders are pampered. Deposit holders are looked after. Perhaps the FDIC is only up to $250,000. So anything above and beyond that, FDIC does not consider that they need the protection. So perhaps in that sense, that investors and traders are considered to be risk takers to begin with, and they should actually be able to look after their own rights and own circumstances, and therefore, um, from that perspective, investors and traders are considered to be less off in the need for protection. So we then have to look for certain, um, signals. What should be a significant signal? So again, in the case of Bernie Madoff, it's easy to talk about this, 2020 hindsight after the fact. Um, However, if a mutual fund or a hedge fund keeps paying double-digit returns year after year, even when the markets are crashing, I think there must be some sort of a suspicion. Um, you know, People also need to learn how to diversify, even if a um, even if a portfolio is paying significant returns. Um, People need to understand the level of risk. So, just because a fund keeps paying double digits does not make it extra risky. Um, but, on the other hand, I think that there's the case of, too good to be true. So I think that burden is on the investors themselves. Um, we also have, certain responsibility for, again, investors to look into the individual investments that the fund or these funds are actually doing. There's a quarterly reports, but I'm not saying that in the case of Madoff, these would actually work. And mutual funds and hedge funds are known to have window dressing for the quarterly reports. Um, However, I guess the only criticism that I would have for overall market is when there are situations, there are individual portfolios or funds that are too good to be true. There needs to be a little bit more scrutiny. This is not to blame the people who invested in Madoff at all. I mean, it's like I said, it's so easy to talk about it after the fact, 2020 hindsight. Um, but on the other hand, to make sure that this doesn't happen again, I don't think that we can rely on an institution like SEC to protect us, like FDIC or the Fed protects deposit holders. That would mean significant more regulation. That would mean significantly more um, compliance and the cost, and these all become um, you know in the investment domain, in the financial market domain, these become um, costly. So, anyways, the content for this week actually includes a 60-minute and several articles. So please go ahead and take a look at these. I think they're really interesting in the sense that we all need to be aware of what can happen, and therefore how we can actually protect ourselves. And I think the lesson really that we need to get out of this is that when it comes to the investment and trading domain, we should not feel safe, that our regulators and our supervisors are not as um, effective or as preemptive as in the commercial banking domain. And this comes at a cost to us, but we also appreciate the returns that we get from it. And so I think that we need to understand how much of a protection we get with each domain. So, anyways, thank you so much, and thank you for working with me. I hope to see you all soon. And if you have any questions, please let me know. Thank you.